Okay, so good evening, everybody, and thank you so much for joining in such large numbers today for this interesting webinar on financial literacy. And as you know, I mean, you already seen the promotional material for this, as well as you can see the slide. It says building a strong foundation. Now, this is an important part which I thought we need to understand and discuss a little bit because eventually the life that we want to build has to be built on strong foundation. The life with it that we live and build, money plays a very important role. And this money needs to be understood in multiple ways. The role of money needs to be understood. And the role of money must be understood in the context of the kind of life that you want to live. And to that extent, financial literacy becomes a very, very powerful idea to learn and understand. How do you manage your money? When I graduated from college, I came across this dilemma for the first time, or doubt or question. The education that you get in schools and colleges, especially in those days when I was a student, it equipped you in a manner that you could get a job and start earning money. So the education empowered one to get employed, start working, and earn money. But the same education system did not impart any education on what do you do after you earned that money. How do you manage your finances? Over the last few years, of course, a lot has changed. A very important developments have taken place. Institutions like NISM or NCFE, the regulators like Reserve Bank of India, Securities and Exchange Board of India, they have played some a big role in spreading this knowledge and uh, also use the education system platform to impart this knowledge to teachers and students. So some steps have been taken, but these need to be taken further ahead. So for that, we thought let's do this webinar. The whole webinar is divided into four different components. We'll first take a look at what is financial literacy, and we'll try and understand the importance of that. The second topic we'll look at is what is budgeting and what is saving. And of course, certain important concepts of compounding with respect to a couple of things. And then we'll look at how do you avoid scams. That's the broad introduction of the program. But before we go further in the program, you also need to cover what NISM is. And I also need to introduce myself very briefly. So let me just go back here. As you can see over here, I'm an adjunct faculty with NISM, National Institute of Securities Markets. I teach certain courses out here at NISM and also participate in webinars like this. There is good involvement in various certification exams that NISM conducts for the people who want to work in securities markets. So that's my brief work with NISM. Of course, I've been associated with NISM in various capacities for more than 15 years now. My total work experience is a little more than 3 decades, uh, and predominantly in financial markets. Out of that, also, a large part has been in securities markets related businesses. So with that experience, I've picked up a lot of knowledge, ideas, uh, understood how various things work, understood how various things don't work. NISM is a capacity building institution set up by the securities markets regulator SEBI. It has multiple roles to play. One of the critical roles that NISM plays is to act as a certification body for anybody and everybody who has to access capital markets as a participant. Now, what do you mean by a participant? So let's say a stockbroker or any employee of a stockbroker must possess certain valid certifications that one has cleared from NISM. A mutual fund distributor must have a valid certification. A portfolio manager providing portfolio management services, an investment advisor registered with SEBI, all these intermediaries need to clear and clear an exam and obtain a certification from NISM. So this is one major part of work that NISM does. Apart from that, NISM runs short-term and long-term courses. These are management development programs, which could be 3 days, 4 days, 5 days, 1 week, or long-term programs, which are like 1 year, 2 year programs, with the sole aim of building capacity and enhancing the potential of all the market participants. The third and then another big vertical within NISM is the investor education and communication vertical, where webinars are like this are a part of the regular activity. Those of you who are living in Maharashtra and happen to travel between Mumbai and Pune through the expressway, from Mumbai to Pune, if you're traveling, somewhere beyond Khopoli, you will see a sprawling campus on the right-hand side while going on the expressway. That's the NISM campus, 70 plus acre beautiful campus that is situated over there. Now, with this background and with my brief introduction, let's just start the program. So as we were discussing, first of all, let's look at why financial literacy is important. But before that, let's quickly look at how OECD, the Organization of Economic Cooperation and Development, defines financial literacy. It's a combination of a few things. It says awareness, knowledge, skills, attitudes, and behaviors necessary to make sound financial decisions and ultimately achieve individual financial well-being. Well, this is probably the last time that I'm reading every word that is mentioned on the slide, but this is the definition, this is the base, and that's why I took that liberty. But let's understand this definition by breaking it into three parts, or bringing out three important concepts out of this. Number one, okay, I'll just, I'm sorry, I just saw the chat messages. Somebody said the sound is low. So is it better now? If somebody can confirm, okay, yes. Am I visible? Is the video visible? If somebody can confirm if the video is also visible, all good. And can you see the slides also? Because there were a couple of comments about it. No slides. Somebody says no slides. Somebody said no slides. I mean, I'm sharing the screen. Yes, slides are visible. Okay. Yeah, okay, Ghanshyamji, thank you so much. It's just that, okay. So if without it, I am more comfortable. Okay. I'm sorry for this brief interruption. Slides are visible, video is visible, and I'm audible. Okay, perfect. Thank you so much. Perfect. Thank you. Thanks everybody. So let's, I was talking about this particular definition. So let's break it into three parts. Number one, financial literacy, unlike many other forms of literacy where you go and learn and acquire knowledge, you acquire skills. In this case, it's not only about awareness, knowledge, and skills, it's also about, attitudes and behaviors. Knowing something is essential, but how do you behave after acquiring that knowledge becomes even more important. It's like I can read thousands of books about swimming, but if I don't jump into the water, then there is no use of the entire knowledge that I've acquired. Secondly, even when I have the knowledge, if I can't or if I don't apply when I am thrown into the water for whatever reason, then also that entire knowledge that is acquired has no use. And to that extent, how I behave as an investor is far more important than the due weightage given to that. I would say it is almost as equal as knowing the theory of the subject. Behavior and attitude is almost equally important. Sometimes it assumes higher importance. So that is point number one out of the definition. Point number two out of the definition is that entire knowledge that is taken, acquired, the skills which have been developed, that is required to take sound financial decisions. And in daily life, it's not about only the big decisions, it's also about those small decisions. Eventually, it's the attitude and behavior that convert this decision into action. And the third part of the definition is the end objective or the aim of this entire exercise about financial literacy. The aim is to achieve financial well-being for the individual. Now, financial well-being again is a concept which is a combination of acquiring enough money as well as having that state of mind to be able to use that judiciously, whatever financial resources one has, as well as to be able to be happy about having that money. If I have lots of money, but I'm always under the stress about money, then I may be wealthy, but my financial well-being is poor. Once again, the behavior to achieving financial well-being, that's where the behavior comes in. If I always operate under the spell of fear, if I'm always envious to my neighbor just because my neighbor happens to be richer than me, then well-being score would be poor. This is how OECD defines financial literacy, and the entire knowledge has to be passed on. The attitude and behavior have to be shaped. When an individual becomes financially comfortable and happy, that happiness eventually spreads to the family, the society that one lives in, and to the whole nation or the economy at large. This is something that is contagious. Initially, it's a slow process, but as more and more number of people achieve financial well-being status, then the growth becomes much faster and smoother. Overall, the standard of living and the standard of life or the quality of life both improve for the economy as a whole. And from that point of view, the same OECD included financial literacy as part of its core objective in the year 2020. And a lot of work has been done across the world, including India. And still, if you look at the surveys conducted by various agencies across the world, the financial literacy scores at large are less than the desired level. And this is not just about India, it is across the world. India, the scores are lower than the developed countries, but even the developed countries don't go above the cutoff marks. And that probably leads to the stress that all of us go through, that uh, takes toll on health, anxiety levels go up, and overall the mental disturbances are caused partially because of the sense or lack of the sense of well-being. That's the importance of financial well-being. Now, what exactly is financial well-being? As we said, it's about day-to-day decisions. It's about daily life. And that daily life is not about which stock is the best, which mutual fund should I invest in, which insurance policy is good for me. No, it's also about whether I'm spending right, whether I'm earning enough, whether I'm earning properly or not. How do I file my income tax returns? How do I maintain the records of my financial uh, dealings as well as the financial instruments that I have? It's about so many of those tiny little things that are often ignored and seldom discussed in public. The first and foremost is, or the starting point is budgeting. Jokingly, we all say that in most countries, but we largely refer to India, that a significantly large number of people can discuss and debate about the budget that is presented by the finance minister in the parliament of the country. But when you ask them about their own household budget, they have no clue. You see, that's one of the parts of that attitude. While union budget is an important document, presentation of budget is an important event, it has many implications on our financial life. That is true. But what is presented in the union budget, we can only respond to those proposals. As far as our household budget is concerned, we can actually define and control that budget. We are far more in control when it comes to household budget. And from that point of view, understanding budgeting is the starting point or the first step in the journey. Budgeting is often seen as listing down the expenses, smallest of the expenses. And that's a burdensome exercise. It's not an easy thing. Even if I have a habit of writing down all my expenses at the end of the day, it is quite possible that on certain days I may miss out on noting down a few items. On certain days, I may completely miss out on writing down my expenses. And that's quite possible. And then at the end of the month, the numbers don't tally. Well, look at budget in a slightly different manner. Again, I'll take the example of the union budget that is presented in the parliament. Those of you who read the financial newspapers the next day, one day after the budget is presented, and I'm deliberately talking about financial newspapers. I know a lot of people say that we've seen the debates on television and we've read the blogs and everything, perfectly fine. But financial newspapers, at least over the last 35, 40 years, I've seen that pattern. They still maintain a particular format. And one of the diagrams that you see, which they borrow from the Economic Survey of India or the Budget at a Glance, where it says where will the money come from and where will the money go. As far as household budgeting is concerned, it's largely about where will the money go. Budgeting as an exercise helps you identify what kind of expenses you would like to incur. Of course, knowing the sources of income is easier for most families. Knowing where the money is going is a difficult choice or difficult item. So how do you do that exercise? And we would focus more on the outflow side because that's where the challenges happen. I've listed down two broad cash outflows. One is the regular day-to-day expenses, and second is what I've mentioned as financial goals. Now, all the financial goals that people have been talking about are expenses in the future. And to that extent, these are outflows. What are the popular financial goals that we discuss about? Well, children's education, for example. What does it mean? Paying fees for the education, and that's the financial goal. Building a retirement corpus. What's the purpose of building that corpus? So that out of the corpus, I can spend money to live a comfortable life in my retirement years. Financial goals of accumulating a corpus to buy a house. I may take a loan for the house, but that down payment amount becomes my outflow. By financial goals, I don't mean investments. Financial goals are events in life for which money is required. Investment is one of the ways of funding the goals. Another way of funding the goals is taking loans. Uh, okay, Bipinji, I think I'll have to hold the mic because it's hanging, and that's why sometimes the voice goes down probably. Okay. Now, when you look at these cash outflows, if you have to list down all the cash outflows, it's a challenging exercise. Some of the leading financial planners that I interact with regularly, they put it in a very nice manner. They say, when you go to a restaurant, the waiter comes and gives you a menu card. Consider that menu card as a list of items that you can spend money on. Okay, so there is a menu card. There are probably millions and millions of items available that you can spend money on. It could be for creation of an asset called a home. It could be for spending on an experience called a vacation, or it could be spending money on a basic necessity called food. Whatever the reason, there are millions or billions of choices that we have. In a typical restaurant menu card, you may not have that long a list, but you may have, depending on what restaurant you've gone to, maybe 5 items to 500 items in the menu card. But when you go to a restaurant, what do? You decide what you want to eat and then order accordingly. In the budgeting exercise, consider that entire universe of products, experiences, basic necessities, luxuries as your list of items to choose from. Your budgeting exercise tells you, okay, these are my choices, and that's why I'm allocating so much money for these items. When I'm allocating this money for these items, then if it's a recurring or if it's a current expense or near-term expense, I'll straight away allocate money. Okay, for this month, my grocery bill would be X amount. So this is the amount allocated towards that. However, If my goal is building a house 5 years down the line, for which I will need a down payment amount of X, then X divided by whatever, or a certain amount that contributes towards that X, that is part of my budget. Okay, I'm putting this much money towards purchase of that house. Now, somebody has said, is it possible that we build a house without taking loans and only with financial literacy? Uh, uh, Nancy, it's possible. Financial literacy will not help you buy a house. How you use that financial literacy, what are your income and expense relations, how much are you saving and how well you are saving, that determines how well your corpus can grow. And then it is about how much money would be required to buy that house, what time do you have to accumulate that amount. So there are multiple factors available. Is it possible? Yeah, it is possible. Is it easy? Well, it may not be easy for a lot of people, but it's not an impossibility. Let me put it this way. But with financial literacy, your odds of achieving that goal without taking a loan are better. And you'll see somewhere along the way how. Okay. But before that, let's look at the regular expenses part. The regular expenses, how do I know if I don't list down my expenses? So one of the simplest things that you can probably consider doing is look at a look at your bank statement. You can take a monthly statement or an annual bank statement depending on whatever is available, but choose the period and keep the period consistent across various horizons. So if you're looking at monthly statements, then look at multiple monthly statements. If you're looking at annual statements, look at multiple annual statements. In your bank statement, there is a column called withdrawal. There's a column called deposit. Deposit is the money that comes in the account. Withdrawal is the money that is going out of the account. Out of the withdrawals, remove those items where you are investing money somewhere. That's anyway for some future expense. So right now, only focus on what you're spending currently. So remove all the investment items. Don't remove the premium that you're paying on your insurance policies, because premium is an expense. When you add up all these items, so all withdrawals minus investments, that's your expenses for the period. It's a very broad number that you'll get. It's a good estimate. And this is what a lot of financial planners ask their clients to start with. When you start tracking this number, you will know at what rate your expenses are going up or down. And then you start splitting and splicing those numbers to arrive at something else. And that something else is okay. So let me just keep addressing some of the questions which are relevant to the discussion. What if we pay our expenses using cash? Well, then you can start writing it down, then make the exercise slightly difficult. Or if the cash is withdrawn from the bank, that money withdrawn from the bank will also appear in your withdrawal part. Okay, so that's anyway covered. If, let's say, you had some receipt in cash from somebody, which often happens, let's say a young kid goes to meet the grandparents on a festival day, and the grandparents give a cash gift to the child, and then the child spends that money. Now that doesn't go through the banking channel, so that doesn't go into the income and the expenses. But otherwise, for most of us, the money goes via banking channel. So even if you're spending through cash, if it goes via banking channel, in the withdrawal, it will appear. Yeah. Uh, okay. So there are a couple of questions which I'll take towards the end. Whatever is relevant for the discussion, I'll keep covering. Rest all I'll cover towards the end. So some of the simple benefits of budgeting that we can understand. Number one, financial goals are future cash outflows. Now, somebody has asked this question about financial goals. How do we define our financial goals? Based on our wish or based on our income? Actually, most of us intuitively know our limits and we don't set too much lofty kind of goals. Most of us. It's intuitive. Having said that, a proper approach to goals would be a trial and error method, which means you may start with your basic needs and you may add on top of it the desired goals or the wishes. So let's say I need a vehicle for commuting. That's my basic need. How do I fulfill that need? I've got multiple options. It starts with public transport. Then I may have a two-wheeler. I may have a four-wheeler. And then within that, you decide based on your personal situation and requirement, what kind of a vehicle would be suitable. Within that, if I decide to take a two-wheeler, should it be a basic two-wheeler or should I take a luxury two-wheeler? If it's a four-wheeler, should I take a basic hatchback vehicle or sedan or a luxury vehicle, SUV? What do I want? Once you do that, and in this exercise, I'm just breaking the steps, but think about your decision of buying a vehicle, and the chances are you would not have done this detailed analysis. You would have used your intuition, but if you break it down the way I've just mentioned, it'll more or less be the same decision. That's why I said most of us do it intuitively. So this is part one. You look at your basic needs and build it up to your wishes. Commuting is one example. It could also be a vacation. It could be buying a home. It could be spending money for wedding in the family or any major event in the family celebration. You keep making that list and then work backwards to check the affordability. And this affordability is a function of not just the income, but the gap between income and expenses. And that's what is mentioned at the bottom. Your savings is the difference between income and expenses. If your expenses are too high, your regular expenses are too high, then automatically your saving comes down. If your expenses are low compared to the income, then automatically your savings go up. Within that, you keep that trial and error. Sometimes people are a bit aggressive and they are okay setting slightly, I would say, optimistic or opportunistic or even beyond that, audacious goals. Sometimes some people set conservative goals which feel easier to achieve. So that becomes a trial and error exercise. But a very long answer to a very short question of yours, how do we set the goals? And yeah, we should start planning all these right from the day of our first job. Uh, Kushagraji, very well said. Yes, right from the first day or sometimes even before that. I remember a statement that Warren Buffett said in the context of investing, not in the context of financial planning. But he said The best time to plant a tree was 20 years ago. The second best time is today. So in case you started working in, let's say, 10 years back, and for whatever reason you not taken the first step of doing a financial plan, do it today. Whatever time is gone, you can't go back to the time machine, but you can always make a beginning today. So the earlier the better is the message out here. Uh, Jagdish ji, I will recommend a few resources for this purpose in the end. Yeah. Now, all the financial goals are future cash outflows, as you already discussed, and they come from the savings. How do you increase that saving? And this is where, once again, I'm quoting Warren Buffett in the letter to shareholders of Berkshire Hathaway in 2009. He wrote this line. He said some of the lessons that we've learned during the global financial crisis of 2008-9, and one of the lessons that he narrated was this: do not save what is left after spending. Now, it's a powerful statement. The issue out here, and I'm not saying Warren Buffett is wrong, all I'm saying is the interpretation of this statement needs to be done carefully. If I read that spend what is left after saving, can I go and tell the owner of my house that let me do my investment first, after that I'll pay the rent for the house? Or can I go and tell the electricity company? The message out here is not so much about reading it literally. It's about understanding that out of all our expenses, some expenses are mandatory expenses. And these mandatory expenses are for the basic food and grocery and medicines. It's about the house rent or the EMI on the home loan. It's about paying the insurance premium. It's about paying the education, the fees for the education of the kids. These are the mandatory expenses. The discretionary expenses are all the luxury related expenses, whether buying an extra shirt is required or not, whether going for that costlier vacation is required or not, whether going to a restaurant one more time. Keep an eye on mandatory expenses versus discretionary expenses. So first we said look at your bank account statement and you'll start seeing the total expenses incurred. After that, depending on your spending pattern, depending on your lifestyle, start picking up the bigger items where the expenses are larger. Start with that exercise and figure out which one of this is mandatory and which one is discretionary. And then start evaluating the discretionary expenses in particular. Mandatory expenses, anyway, as the word suggests, are mandatory. But can I cut down on some of the discretionary expenses? Because if I'm able to do that, my savings would go up. But a line of caution out here. Once again, it's about interpretation of some of the lines. I'm saying, can you cut down on some of the discretionary expenses does not mean that you stop enjoying your life. And this is why I'm deliberately mentioning that financial goals are future cash flows and cash outflows are divided between current expenditure and future goals. As we were discussing earlier, you save and invest to fund your future goals. That saving comes after the money is spent. So income expense savings. Now, a lot of times people ask this question that you are asking us to save money for a better future, but you are asking us to stop living today. The idea is not that. The idea is to strike a balance between today's life and tomorrow's life. And this is where behavior plays an important role. Which behavior? There is a tendency in all of us called seeking instant gratification. We want the pleasure now, and we are okay deferring pain or delaying pain, or we rather want it that way. The truth is, we have to strike a balance between the two. Once you are able to cut down on the discretionary expenses, then the amount that is saved needs to be put to use. And that's where investment works on one very powerful formula. And that powerful formula was taught to us in higher secondary mathematics class, the so-called compound interest formula. Within this equation, as you can see, amount is what is accumulated at the end of the period. You can call it wealth, you can call it the goal value. P is what you invest. Now, this particular equation, because of the limitation of the slide, we put the simpler of the compound interest equation. It looks like a one-time investment, but there could be multiple investments. So P1, P2, P3, etc., etc. Is what you invest, how much you invest. N is the time period for which you are investing in. R is the rate of return on investment. Now, out of the three variables on the right hand side, which is P, R, and N, your objective is to enhance your wealth. Objective is to achieve the financial goal. There are three variables on the right hand side. Between these three variables, the maximum control that we can exercise on is on P and N, and the least amount of control that we can exercise on is R. How much return we will get is determined by too many factors beyond our control. How much can I save? Well, and that's where discretionary expenses can come in. So a higher degree of control can be exercised there. And how long do I stay invested? And let's break the three down further. In order to increase wealth or achieve goals which are, and let's say we are discussing about, should the goals be in line with our wish or income? If the goals are loftier, then you need to save more, you need to stay invested for longer period, and you should aim for higher return. A combination of these three would help you achieve the goals. However, in order to save more, discretionary spending needs to be controlled. The OECD financial literacy surveys hinted at something that a lot of people do not understand. The simple basic equation: higher income does not result into higher wealth. It's the higher saving that results into higher wealth. So higher income with higher expenses, and well, it may not help create any wealth. Longer horizon can be achieved when we stay invested and keep reinvesting the proceeds or the income generated by investments. If I've invested in a a product which gives me interest. It could be a debenture, bond, fixed deposit, small savings scheme, whatever. If there is an interest income, what do I do with that interest income? If I use that and spend that money, then I don't get any compounding benefit. The same for rental income from house properties, same for dividend income from equity shares. If we keep reinvesting, then we get the power of compounding, which is nothing but earning income on the income that is reinvested. Number two, and this especially happens in volatile markets like equity markets or stock markets. When the markets are down, a lot of people take their money out. The moment we take that money out, we are interrupting the process of compounding. Ideally, when equity markets go down, shares of good companies have now become cheaper. It might make sense to buy more and not sell anything. But the behavior, the fear, the doubt, and that plays a role. Higher returns can be achieved, but not without higher risk. And that's where it is important to understand that if we lose the capital, we can't achieve higher returns. Take risks to achieve higher returns, but understand the risks, manage the risks well. And there are multiple principles to manage the risk. We'll talk about a couple of those in sometime now. But management of these risks is crucial. If we take a risk which we don't understand, then the chances of losses are much higher. Take, for example, SEBI conducted a study and issued a report sometime in 2023, 24. And as per that report, 94% of traders in the derivatives markets lose money regularly. 94%. So there are only those 6% who make money. Now, derivatives could be useful in multiple ways. One is to manage risk. The other is to enhance return because of the inherent leverage. But if I don't understand and use derivatives, then I'm likely to be more in the likely to be in the 94% than the other 6% who make money. While the attempt was to enhance returns, the product was not probably understood. SEBI also extended that report to day trading in stocks. And that report says roughly 2/3 of the people lose money day trading in the stocks. Apart from that, there are some ways which are out. I mean, these are regulated markets, by the way. So if you're losing money in a regulated market, it's not that somebody's committing something wrong against you. We'll come to the other risks in a while. But before that, the whole discussion on compounding becomes important because whether the investment returns compound or not, the expenses that we are incurring to live a comfortable life, they keep increasing. The financial goals that we have set up for ourselves, the money required for that, those values keep going up. So the inflation is something that we need to beat. And in order to beat inflation, the return on investments have to be higher. Inflation is cumulative. The expenses keep going up at the rate of inflation. And to that extent, the return on investment, if it can't beat inflation, then we will fall behind. And in future, we'll have less money than we have today in terms of the power to purchase, the so-called purchasing power, the ability to purchase. Inflation and investment returns both can compound. Inflation, it automatically happens. Investment returns, we can decide whether we want that benefit of compounding or we don't want. While there are investment related risks which can be understood and controlled by proper portfolio planning, the other risk, which is behavior related, that can be controlled through proper management of behavior. But the bigger problem in today's time is the scams that we are exposed to. And when we look at the scams, financial in particular, online frauds, online scams have increased in large numbers these days. A quick look at those online scams, and you must be familiar with many of these lines. It's not that people are not aware of these things, and still learned, educated, smart, intelligent people keep losing money every now and then. And it appears in various news media, discussed, debated, and forgotten. The regulators have been highlighting about these things on a regular basis. One of the recent newspaper articles, I mean, it's just a 2-month old article. Just imagine somebody losing 20 crores in case of a digital scam, an online scam. So what happens in such cases? Internet is a very powerful medium if we are able to use. Social media is a very powerful medium to stay connected with the world, to various people. If used safely and properly, but there are unscrupulous elements who use it, or rather abuse it, to cheat and defraud common people like us. They look for certain information. Now, if you share these things openly without verifying the uh, person on the other end, you are divulging this information. PIN, passwords, OTPs are quite common, and learned people have fallen victim to these kind of things. But please remember, no regulated and registered financial institution would ask any of these details through email or through phone calls. There are IVR based approaches, well, but that's a separate thing. Nobody would say, you give me an OTP and I'll punch it in audio, punch it in on your behalf. The moment you sense something fishy, it's better to put down the call, cut the connection, or get out of that site. Any link that appears in your email, or you are asked to click on a certain things on in a website that is giving something free and trying to capture your data, unless you are comfortable with that website, you don't have to divulge that data. It's better to lose an opportunity than to lose capital. So there are some very small items that you need to take care of, and they're mostly you are safe. The offline scams or the old school scams are partially divided into two categories when it comes to investment related scams. One is called that so-called Ponzi scheme, where somebody presents a mouth-watering and lucrative investment opportunity which is unsustainable, which is unrealistic. But the first investor gets the money when the fraudster takes money from a second investor. So second investor's money is paid to the first investor, third investor's money is paid to the second, fourth investor's money is paid to the third. So long as that chain continues, people keep getting money, and that builds confidence. And then at a particular stage, when the stakes are reasonably high, this person then runs away, gets out. Recently in Mumbai, there was a particular jewelry firm which was offering 11% weekly returns. 11% per week? I mean, and a lot of people lost money, unfortunately. The Ponzi schemes are one type where unrealistic and unreasonable returns are promised. The second is where you did not ask for an investment tip and somebody added to your WhatsApp or added you to a WhatsApp group or a Telegram group or whatever messenger service that the person may be using. You did not participate in it. Somebody added you or invited you. Be careful in such cases. They may showcase their track record, but it will be on a selective basis. My clients have made so much money in such a short period of time. 90 out of my 100 calls have gone right. When somebody has such a track record, just stop there and ask a question. How come this person's name is not Warren Buffett or Rakesh Junjunwala? With that kind of a track record, this person should have been ahead of these two, right? Now, these offline scams, as far as investments are concerned, are quite common. Some of the red flags that you need to know. Of course, in the online scams, somebody asking for personal details, confidential details, that's a red flag. In the offline scams in particular, when you hear any of these terms, guaranteed returns are not a problem. High returns are not a problem. But high guaranteed returns is a red flag. High returns with risk, possible. Low returns without risk, possible. High returns with low risk or high returns with zero risk, that's a red flag. When somebody says that this is a amazing opportunity to earn money and it's only available for limited time, it's only available for select people, that's a red flag. Don't rush. Don't rush. And that's exactly what is mentioned in the last point. 32 years in capital markets that I've spent, I've learned something. Opportunities keep coming and going. You are anyway not going to participate in each of the opportunity. You can't. Then let some go. Safeguard your capital. Always deal with entities which are regulated with the regulators. And there are 4 regulators in financial markets. Reserve Bank of India, which regulates the banking sector, the housing finance sector, NBFCs. SEBI, which regulates the securities markets, capital markets. IRDAI, which regulates the insurance sector, and PFRDA, which regulates the National Pension Scheme and the Atal Pension Yojana and related schemes. If you're dealing with any of the investment products, if it comes from outside of any of these 4 regulators, your alarm should start ringing. So let's say there are investment products with insurance companies also. There are, NPS is also a sort of an investment product, though it is for a specific purpose called retirement. You may have deposits with NBFCs and banks. These are all under the regulation of any of these four regulators. Check whether the entity is regulated or not. There are advisors and there are distributors of financial products. They also need to get registered, or they are regulated directly or indirectly. Check those registrations and regulations. A few things happen when somebody is regulated. Number one, they have to operate within certain guidelines. An unregulated entity can operate whichever way. Second, there is a grievance redress mechanism which is standardized. In case of any grievance that you have, where do you go and complain if the concerned party is unable to provide a solution to you? Final slide. We're already at 5 o'clock. Additional resources that somebody was asking about. Somebody asked about books. I have not mentioned books, but some of the resources which are available, and last two are available on SEBI's website. Rather, SEBI has created an investor website, which is the second last point. And SEBI has also developed an investor application, which is an education plus kind of a resource called Sarthi app. The second hyperlink that you see out here is a detailed 22-hour course called Financial Literacy for Bharat. The other three are shorter term, shorter duration programs like 2 hours or less. The first, third, and the fourth. But use extensively. Keep visiting NISM website. There will be a lot of stuff regularly happening. So with that, let me go to the questions that some of you have asked. Okay, bear markets create smart investors create bull markets, and bull markets create stupid investors, and they create bear market. Wonderful, thank you. This is good, Anshu Adhikari ji. Jagdeep Sharma ji asked about gold. I mean, it is just one word, so I don't know what the question could be. But gold, yeah, gold is also an investment avenue. Uh, it's just that in case of gold, it's just the price appreciation. If you are talking in context of the reinvestment of proceeds, gold doesn't pay you anything. If that's the case, but yeah, gold is also an investment avenue. I got automatically in WhatsApp group which says 5% returns minimum per day. Exactly. So Prasad ji, you can report that group and exit. I would say that's the best course of action that you can take. Uh, Pondicherry schemes are dangerous. Ponzi schemes. Yeah, Ponzi schemes are dangerous. Yes, Harsh Tiwari ji. Uh, What about time value of money, sir? So time value of money, yeah, I did not go into the details of it because we had a limited time. But yes, that's an important concept to understand in terms of financial literacy. How can we defeat inflation? You can, Harsh Tiwari, you can look for investment avenues where the potential return is higher than inflation. But the moment the potential return is higher than inflation, you are taking some risk. So understand how do you manage that risk. One of the simplest concepts to manage risk is diversify your investments. Second is look for good quality. So you look for good quality and diversify across good quality. Third, keep investing on a regular basis. And fourth, stay invested for longer periods. So these are the four basic principles that most of the common investors like us can use. Does the compounding work on only traditional investments like FD, or because in stock markets, a fall in the market can completely erase the benefits of principal or time? Please clarify. Uh, yeah, Meghaji, in stock markets, yes, the volatility can erase some of the previous gains. However, if you extend the time horizon, beyond, let's say, a decade, then there are very, very fewer occasions when 10-year return would be wiped out. Uh, I'm talking about globally. So while there are countries where they have seen negative 10-year returns, but those instances or examples are very few. You can count on your fingertips. Uh, so compound P, no, no, it is P, not R by N. It is R by 100 raised to the power of N or T, which is the time horizon. Derivatives refers to Sandeep ji. Okay, so derivatives are securities markets products which are whose value is derived on something else. So there are equity derivatives, there are interest rate derivatives, there are commodity derivatives. Multiple things are available. Check the NISM website under the training programs. There are training modules. There's a module on derivatives in case you are interested in understanding it further. Savings per month or year. It depends on your cash flow. If you have a monthly surplus, you can save on a monthly basis. Uh, Okay, so Nancy ji, savings minus expense equal to income. No, income minus expense equal to savings, or income minus savings equal to expense, whichever way you want to look at it. But mandatory expense may be required to be incurred first. The discretionary can be done after you completed your savings target. Mandatory are must-have expenses where we cannot control much of it, or you can't avoid. Yes. The Q&A. Okay, may I ask? Okay, there are few questions about certificate. When will somebody get it, or when somebody gets e-certificate, etc. So maybe we'll address that. How can you become financial advisor? Abhijit ji, there are resources available on NISM's website. You can check those, and the details will be available. Today's webinar is not the right forum, so I'm not answering this directly. So I should have looked at this question earlier. What is project appraisal? No, project appraisal is a completely different thing altogether. So not related to today's topic. Uh, yes, Dinesh ji, sometimes expenses come unexpectedly. Yes. Those are some of those are you can anticipate, or you can identify. Though the probability could be low, possibility cannot be ruled out. It's up to us to decide whether you want to provide for those or not. Now, let's say there are certain expenses which happen on account of health. There is a health insurance available, so you can keep aside some money and plan for that. The example of health insurance is specifically given because there are some expenses where certain financial products called insurance is available. There are certain expenses where nothing may be available, no such insurance may be available. So you can decide whether you want to keep some separate fund for those kind of expenses or not. If you don't, then you have to dig into your long-term investments. But that's a choice that you make, because if you keep putting the capital aside in a safe kind of investment avenue, then because it is safe, you are not taking risk. You are giving away the chance to earn more. So it's a choice that you make whether you want to play safe with some part of the money and uh, take investment risk on some other part of the money. But yes, your point is valid. Some expenses could be totally unexpected and unthought of. I'm investing in SIPs and mutual funds. Will it count as expenses? No. Sagarji, this is investment. So it's part of savings, not expenses. So SIPs or mutual fund investments, if you're buying stocks, if you're doing a fixed deposit, these are savings, or you can combine to savings or investing, not expenses. Does the compounding work only on so Meghaji, I've answered that. Getting a pop-up on Instagram to buy a course for 200 rupees that includes a lot of courses. Is it a type of scam or black market seller? Sagarji, without knowing the specifics, it may not be possible, but uh, if somebody is giving you a brochure to check, if there is a link of website that you can go and check, so long as you are not asked to provide your personal details, so long as you are not asked to make any payment at the time of doing your research about the course, I think it's okay. If somebody asks your personal details, now personal details don't mean your uh, email ID, for example, or your mobile number. If somebody asks your bank details, PAN number, then don't go there. But you can verify through or do a separate search on that entity and try and figure out. Some people might be offering some courses for 200 rupees or even less, like let's say a financial literacy for Bharat course that NISM offers. NISM being a not-for-profit institution, that 22-hour content is available for free, right? So some could be genuinely cheap or free, and some could be, if somebody is asking for personal details or money, then your alarm bell should start ringing.
Hello, sir. Sorry to interrupt.
Yeah, yeah.
Yeah,
Yes,
so
please.
I request you that now we can wind up the session as already it's time up now.
Right, right. Perfect. So thank you so much. Thanks everybody. Thanks for this interaction. Lot of questions, lot of meaningful questions. Can't cover all. Uh, on behalf of NISM, as well as you know my own self, uh, extremely grateful for your participation in today's program. We keep doing these webinars on a regular basis. Keep visiting NISM website. Keep checking the details. NISM is a capacity building institution. It's spreading financial awareness and literacy. It's a government of India's securities market regulator SEBI's initiative. So to that extent, you get the most authentic kind of information out here and knowledge out here. Thank you for joining. See you some other time later. Thank you so much.